Hello and welcome to my YouTube channel, The Accounting Educator. I'm Ahmed, a senior lecturer in accounting and finance in a UK university. I also work with ACCA as an early career ambassador. This video is relevant if you're currently studying consolidated financial statements. In my previous video, I have gone through AAT Level 4, drafting and interpreting financial statements, practice assessment 2, task 5, part A. So where I have gone through how to prepare a consolidated statement of financial position in a given situation. In this video, I will be going through how to prepare a consolidated statement of profit or loss or consolidated statement of comprehensive income. So this situation is provided to us. As you can see that there is a parent company, which is Flash PLC, and a subsidiary company, which is Power Limited. And we've been given some additional information here. Now, when it comes to revenue, it will be two companies' revenue together. And then, of course, we might have to make an adjustment. If there is any intercompany sales, we must have to remove it from the consolidated revenue, from the consolidated sales. And why is that? Because we treat the whole group as a single entity, as a single company. And one company cannot sell something to itself and generate revenue. So that's the reason that we must have to remove the intercompany sales from the total revenue that goes into the consolidated statement of comprehensive income. So consolidated revenue prior to any adjustment, simply this one will be just adding two companies' revenue. So as you can see, the revenue for Flash PLC is 16,850 plus revenue for Power Limited is 5,806. So that gives us a total of 22,656. And the adjustment we need to make is, of course, we need to remove the intercompany revenue, intercompany sales. So if you look at the second bullet point here in additional data, it says during the year ended 31st of December 2021, Flash PLC sold goods which had cost 240,000 to Power Limited for 300K. So that 300K revenue is intercompany revenue. So what we need to do, we need to remove it from the consolidated revenue, and that is 300. Okay, so that gives us the consolidated revenue after the adjustment. So that will go into your consolidated statement of comprehensive income. That is 22,356. Now, cost of sales, remember that how we calculate cost of sales, normally that's opening inventory plus purchases minus closing inventory. Now, in that purchases, there is intercompany purchases. Remember that was sales for one company, one group company, and purchases for the other company. So it had costed them, remember, 300. So therefore, the intercompany purchase we must have to remove. And additionally, if there is any unrealized profit, we must have to remove it from the consolidated cost of sales. So unrealized profit is profit that is as a result of intercompany purchase, but the goods are still remained within the group. So in other words, the company which has bought it, they still have those goods. So any profit in relation to those goods is unrealized profit. The goods which are sold to third party, that profit has become realized now. So that's not unrealized. So only profit which is in relation to the goods remained in inventory of the buying group company at the year end. So if you look at this information, they tell us that 1/3 of these goods still remain in inventories at the year end. So first of all, if you calculate the total profit is 60K, which is 300K minus 240K, and 1/3 of 60 is going to be 20. So we add that back. So in a nutshell, it will be 300. Remember, intercompany purchase, we must have to remove it, but then we are adding back 20. So the net effect of that is going to be, we are going to deduct 280 in here. So first of all, before this adjustment, you will be just adding two companies' cost of sales. So what is the two companies' cost of sales? And that is 11,610 plus 4,356. And that gives you basically 15,966. And the adjustment here, it will be minus 280. Okay, so if there was no unrealized profit, we would have just deducted intercompany purchase of 300K. But the reason this 280 is because remember we add back unrealized profit. So let me quickly show you in Excel sheet here. So can you see before adjustment was this? So we are deducting 300 and we are adding back 20, and that gives you 15,686. But what I done in that question, because remember that they just given you space for one adjustment, so the net adjustment will be, we are deducting 300 and we are adding 20, so net adjustment will be deduction of 280. Okay, let me take you back to the question now. So as you can see that the cost of sales, adjusted cost of sales, consolidated cost of sale is 15,686. So if we deduct this from the revenue, that gives us the gross profit. Now, other income, if there is any intercompany dividend and they have recorded it as other income, we must have to remove the effect of that. Again, that's intercompany transaction. That's the group transaction. In other words, related party transaction. But in this case, that there is no information that any of this other income is in relation to or as a result of intercompany dividends. So therefore, that this other income, we will be adding it here. So 176 plus 10, that gives you 186. But we have to deduct the operating expenses. There is no adjustment in relation to that. There is no additional data provided to us. So all we have to do is just add these operating expenses of two companies and deduct it from the consolidated statement of profit or loss. So 3,346 plus 870, that gives us 4,216. Okay, so that's your profit before tax now. Now in this question, they didn't really ask you to split it between NCI, that is non-controlling interest. Let's remember that the remaining 20% shareholders, and how much belongs to the group. But if they would have asked you, then the NCI portion will be, remember, non-controlling interest only have interest in the subsidiary, not the parent company. So you're not going to calculate that on this 2640. You will be calculating it from the subsidiary company profit. So 590 times by 20%. So whatever that amount will be, that profit belongs to NCI, and you will deduct that amount from profit before tax, and remaining profit will be attributable to group. Okay, thank you very much for listening. I will be back with another video.